Hello, everybody. This is Noah and John, and we are from UrbanDigs, and it is Friday. So you're going to get your weekly Manhattan market update. John, let's get right to it. I'm looking at supply. We're busting out over the seven handle, 7,011. Show me that chart.
Yeah, it's up off another 5.5%. So supply is on the rise as we start this fall listing season. But if you'll notice that chart, right, it's right on track for where it was last year at this time. So actually maybe just a little bit below. So even though the supply is coming back, Noah, it's not as heavy as it's been in the past.
Yeah, it seems like supply in general is just tight. I mean, it's not low, it's not high, but I'm hearing anecdotally that the inventory is tighter than what this number looks like, and maybe it's because the scarcity of quality product, or the combination of quality product and sellers that are really willing to hit the bid where the market is today. There might be some hesitancy on the sell side for that. Maybe that's why buyers are thinking that inventory is tighter than it looks. But it's over the seven handle, so we'll see where we go during this listing wave season. Let's move on to Manhattan demand pending sales, 3,198. Johnny, show me that chart.
Well, no surprise here. That's down another 3%, and we're expecting pending sales to kind of keep grinding lower until buyers have had a chance to get out and start signing some contracts. So again, another week of pending sales, slightly lower, but this trend is coming to an end soon.
Yeah, I think in a couple more weeks, and then we're going to start to see that hopefully tick back up, unless we're wrong, of course, and that just keeps grinding lower, which is possible. But we'll see, because this is a new era of deal volume, and this new era of deal volume is nowhere near what we just went through a year and a half ago, and that's why this market pulse, Johnny, is trending lower as supply comes on and demand goes down. This is going to tick a little lower, and it's probably going to continue to tick a little lower for the next few weeks until it changes sometime in early to mid-October and starts to go up. So for buyers, there is a leverage advantage right now, whether or not they think it or they believe it. Right now, this market certainly is affording buyers a lot more leverage opportunities than just 3-4 months ago. So let's go to the ticker and the weeklies and see if there's any clues there. I'm looking at supply 1 week, 569. That's a nice pop, Johnny. Show me that chart.
Yeah, it's a nice pop. It's almost 19% higher than it was last week. And we were just talking about how supply has not been as heavy as it has been previously. But this week's supply was actually above the trends from the last couple of years in terms of the weekly numbers of volume. So we'll, usually you start out after Labor Day with a couple of pops and it fades from there. So we'll see how this
Yeah.
goes, Noah. But this is, in terms of supply, a step in the right direction.
Yeah, it looks like it's starting late, but it's starting nonetheless. And that's kind of what we need to see for this listing wave season. Let's move on to contract signed, that all important measure of demand for the weekly pace. I see 167, Johnny, and that is a nice pop up from the prior week. Is this the beginning of a trend? I don't know. Show me that chart.
Yeah, it's a little too soon to tell if this is the beginning of a trend. It's certainly, we saw a trough last week with the holiday. Now we kind of bounced back up. We're up, nearly 42% above that low that we set last week. But again, we're right on trend with 2020, 2019. We're nowhere near the 2021 levels. So the question is,
Yeah.
If we're rebounding here, rebounding on the normal trend, are we going to be above that trend, below that trend? It's really too early to see.
Yeah, and you know what? That's a really good point that you made. We went from going really fast, really, really, really super fast, and now we're right back to the historical norms. And that's very important for people to think, because it feels relatively slow because of how fast it was. But
Yeah.
in reality, we're still doing 720 contracts signed on a 30-day pace in September right now, which is our lowest deal volume month. And I just put out a piece, Johnny, for our subscribers out there that like to read our research notes, target levels to watch. And this is supposed to be around 687 by the end of this month. So when I see it at 721, we are above right now, even though the month didn't end yet, so we probably may tick lower still. 687 is where we're supposed to be. What I'm looking for is where we're supposed to be at the end of next month. This is supposed to go up to 950. So that's
Right.
that sentence that you said earlier, is first the stuff comes on and then we have to wait for the contracts to be signed, and that's what happens in October. So I'm looking to see those levels, 687 on the downside, 950 on the upside, to see whether or not we continue this seasonal norm. Johnny, let's go to the chart du jour. I believe you got listing discount based on days on market, and that's starting to show a little bit of a change. Johnny, why don't you explain it to our users?
Well, we basically broke up all the contracts signed and followed them to their closing and saw, depending on how long they were on the market, what that listing discount was. And you can see that, that first left-hand bar in each of these months, that's the under 30 days. And that's remaining relatively low. It started to pop up a little bit for the July closings. Still a little early for July closings, but it's coming in a little bit under 2%. But you can see, the 30 to 60 and the 60 to 120, those are starting to increase as well. And so that spread is growing between what I would consider to be properly priced properties, right? You're at market priced, and the ones that are a little bit above that have to negotiate down. And why this is interesting, why I think this is an important chart, is because over the week, right, we had the CPI print come out, and it's basically forcing everybody to rethink what that terminal rate at Fed funds might be. And that's going to possibly inflict a little bit more damage in the mortgage market. And that might translate into the equity market as well. We might see some pain there. So as these markets sort of readjust and reshift, buyers are now going to be reacting to that. And that's going to start resetting where they're thinking prices are. Hence, you need to be pricing it right, or you're going to be paying a price.
Yeah. This chart really visually shows you the pain that you're going to feel if you fail in your pricing strategy. So this is a conversation I think every professional real estate broker needs to have intimately with their sellers before they start their listing journey, because you don't want to miss that first 2, 3, 4 weeks of high traffic when there's discovery of your listing to the buyer pool that's out there looking to buy that sector. And if you just miss that first 3, 4 weeks, then you're really in a situation where you have to re-stimulate activity by a price cut. And then you start going, well, how much do I lower the price? Do I do it a little? Do I do it a lot? And then as you get further down that curve, you're on day 30, day 60, day 90, you start doing price cuts. You're not getting that activity. It's because the buyers already saw it. So you have to take advantage of the beginning. And the fact that this less than 30 days is starting to rise from zero. It was at zero for how many months here? I guess the last 5 months it was at zero. So if you're lucky enough to get a contract in that first month, you were basically getting near full S. That is now starting to tick up. And again, this is second, third inning stuff. Third inning stuff. So over the next few months, we're going to see the rest of this down cycle and get discovery on that, Johnny. And, you mentioned the target terminal rate of the Fed funds rate. And there's a lot of confusion out there with what's going on. So I wanted to just take a minute and talk a little macro right here. Okay. What you're looking at right now, this top blue line right over here, that is the latest expectations as of September 13th, right? So a couple days ago, of where they expect the Fed funds rate to go. And if you look at where that expectation prediction was 5 weeks ago on July 27th, it was way down here. And you could say it just keeps going up. It just keeps going up. And that is what you need to worry about. It's not that the Fed's going to hike rates, Johnny. They are. The Fed funds rate's at 2.25 right now, and they expect it to go to 4.2 by next April. So there's 200 basis points of Fed hikes. They could go ahead and hike 200 basis points, and we will not see any change in mortgage rates unless this terminal rate bumps higher again. And that's what everyone needs to understand, is that basically what is happening here is that the street and the markets are not believing how far and how high and how long the Fed is going to have to hike rates and keep it there, right?
Exactly.
To combat this inflation problem. And this is just really an expectations thing. So the market's expectations keep getting reset. And that's why mortgage rates have reset higher. So it's all about that terminal. And hopefully you understand now that if that terminal stays where it is for the rest of this cycle, this is the unknown, we don't know that the Fed can hike and mortgage rates are probably going to be priced in already of what it is. And that's the most important thing, Johnny. Okay, Johnny, thank you for pulling up all this data. That is John Walkup. I am Noah Rosenblatt. This really does help to see what's going on in the market at a very challenging and complex time. If you have any questions, please visit our forum. We'll be happy to answer them. If you want any of the charts that we discussed today, John's going to put them right over here in just a few moments. Other than that, this has been your weekly Manhattan Market Update, and we'll catch you next time.